The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The rally pauses as investors wait for Iran, for Warsh, and for the next earnings season. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. And as Romaine said, a bit of a pause in the unbridled enthusiasm that we've seen over the past couple of days. The S&P 500 down about 0.3%, a bit more selling pressure when you take a look at what's going on with big tech as measured by the NASDAQ 100, now lower by 1.5%. Even though you are seeing more of a move start to pick up when it comes to Brent, trading below $80 a barrel right now, and a bit more of a response in the bond market. 10-year Treasury yields currently lower between 4 to 5 basis points. The 10-year trading at 4.42%, as you say, Romaine, as we await Kevin Warsh's first Fed press conference.
That's 79.25 on your screen for ICE Brent crude, really catching my eye. The longest daily slide in oil futures all year long, pushing prices back down to levels from early March. Both Morgan Stanley and Goldman cutting their price outlooks, with Goldman assuming Persian Gulf oil exports could actually reach pre-war levels by the end of July. That's, of course, assuming the U.S.-Iran ceasefire deal does indeed reopen the Strait of Hormuz this month. But not everyone is as bullish about how quickly those flows will return to normal. Here's Jeff Curry.
The answer is it's going to take months and not until the end of the year. Let's say the ceasefire, it works as planned on Friday. It would be probably by the end of the year you could even begin to talk about a resumption to normality.
Yeah. So the malaise in equity markets today likely tied to a lot of the question marks that Curry raises around the Strait, as well as a lot of question marks around Kevin Warsh, who is chairing his first FOMC meeting as we speak. And remember, the three-day rally in stocks that preceded today may have actually been more of a technical function of short covering rather than any sort of material conviction of more upside. At least that's the cautious narrative. There is a more bullish narrative out there that can actually be found in the latest Bank of America survey that shows the majority of investors viewing the current stage of the AI cycle as still in a boom rather than in a more ominous euphoria stage. And then you have a fresh earnings season that actually starts 4 weeks from today, Katie, amid upward earnings revision momentum, which is hitting heights not seen since 2021. Are you going to be here for that?
I am still going to be here for that, for better or worse. A lot to look forward to. I do want to take a check on what sort of market environment potentially those earnings might land, because we've been talking a lot about this broadening out trade, even with tech resurgent here. And this chart behind me really illustrates that point, because in white, you have the S&P 500. In blue, you have the S&P 500 equal weight, which sort of neutralizes the impact of those mega cap tech names. And it's a really interesting story over the course of 2026. You can see that the equal weight came out strong out of the gate. It held its lead over the S&P 500, the market cap weighted index, throughout the start of the war. And now it's neck and neck. Even though you've had big tech sort of lead this bounce back that we've seen since the end of March, you can see that actually it's the equal weight index that still has the slight advantage over the mega cap index there. So it's going to be really interesting to see how these lines continue to interact with each other, and of course how we see the broadening trade, that rotation trade, sort of materialize and evolve from here, Romaine.
Absolutely. That equal weight up top with on the day financials, industrials, and utilities leading the charge. Let's kick things off as we move closer to those closing bells with Lizanne Sonders, Chief Investment Strategist at Charles Schwab. And Lizanne, I do want to start off with the potential for a more broadening of this bull market, assuming that it does resume despite the red on the screen today. Do you have some conviction here that, given what we know about earnings so far, given, I guess, the potential that the Strait of Hormuz could potentially be open in a matter of days or weeks, does that give a little bit more of a reason to buy into some of those economically sensitive sectors?
Yeah, and thanks, Romaine. Yes, I do believe in the broadening out trade. I think it'll happen with fits and starts, not in a linear way. Compared to my view that I had just on the eve of the war beginning in late February, maybe not as strong as view then, because in that environment, at the end of February for the prior 2 months, which was year to date at that point, almost 70% of stocks within the S&P were outperforming the index itself. Now we're talking only about a third of stocks over the last month or two are outperforming. So it's made some headway. But I do think what we're likely to see is continued rotations that provide leadership in areas other than those largest of large names within the S&P. I still think there's going to be a large cap bias. That's the nature of what the S&P index is, regardless of whether it's cap weighted or equal weighted. We're still talking about large companies. That said, even the Russell 2000 is outperforming the S&P this year by a fairly wide margin. So I think there are plenty of opportunities. I don't think individual investors in particular need to be as concentrated as what's embedded in the construction of those indexes.
How much of a tailwind do you think that a sustained drop in energy prices could actually be? I mean, back in early April, we were above $112 a barrel on WTI crude. We're at 76 now, still above where we were at the start of the war, but the trend line seems to be favoring getting back down to those late February levels.
Well, I'd be cautious about applying this to be some sort of significant tailwind to the economy or to the inflation statistics, because it didn't really represent quite the headwind as a lot of people thought when we had oil prices hovering in the north of $100. So what we proved through this period is the resilience of the economy, even in the face of an energy shock like that. I think maybe the more relevant question as it relates to big picture macro policy is through the inflation channel and what the Fed's reaction function is going to be. It clearly eases that headline inflation pressure, but I think the rub is that a lot of those inflation pressures, especially those feeding into PPI, are also AI driven. This is not just an energy story. So I think we're going to have to think bigger picture as it relates to the impact that it's going to have on inflation metrics.
Well, with that in mind, Lizanne, of course, tomorrow we see Kevin Warsh really truly take the helm of the Federal Reserve and deliver his first press conference. And given that, we haven't actually heard from Warsh in a while now when it comes to specifics on monetary policy, what specifically will you be looking out for once he does take the stage tomorrow?
Yeah, a whole host of things I think should be on everybody's radar. I don't anticipate that Warsh is going to announce anything in a definitive way. That's not the nature of the Fed. It's not his nature. I think there might be telegraphing. There certainly would be part of the discussion. But I'll be paying attention to comments, obviously, around the balance sheet, given his expressed desire for a smaller balance sheet, the periodicity of press conferences, whether he shifts back to an every other meeting frequency, what his views are on the dots plot, whether he actually publishes a dot relative to everybody else ostensibly still publishing dots, what his thoughts are on the value of the summary of economic projections. So I think that's what's going to capture the attention of the press at the press conference, are those open-ended questions that he's going to be sort of forced to start to put some finer notes on.
Absolutely. And when it comes to sort of the method and the frequency of communication, certainly that's been a topic that we've been discussing here on Bloomberg TV. The idea that Kevin Warsh, it seems like he would like the Fed to speak a little bit less. Bloomberg had a great story out today, and the consensus seems to be that that could inject a little bit more volatility into the market. I wonder what your view is, though, when you think about the idea that maybe we'll start to hear a little bit less from the central bank, or at least less frequently.
Yeah, and I don't say this in a derogatory way, but I've often joked in this more recent era of lots of Fed speakers that it's a federal open mouth committee. And I think it would be a change, because we do see the markets on an intraday, on a day-to-day basis reacting, particularly when there's a cacophony of speakers out there, either because there's a shift in direction or the mood being expressed by Fed members, or at times a volatility driver because there's differing views and more dissent. So I think it would be, I'm not sure if it would be a particularly negative reaction that the market would have, but it does mean a different backdrop when we're in that open window for speakers if there's a bit more silence than there's been in the past.
Lizanne, always appreciate it. Lizanne Sonders, Chief Investment Strategist over at Charles Schwab, kicking us off to the close here on this Tuesday afternoon with a closer look at SpaceX, up for a third straight day, and a lot of questions about valuation. We talk to the Dean of Valuations when we come back after the break, Aswath Damodaran, Professor of Finance over at NYU Stern.
Then a reality check closer to home, a look at the broader trends in the real estate sector and what companies can do in the current environment with Christopher Merrill, co-founder and global CEO of Harrison Street Asset Management.
And an exciting World Cup match yesterday out in LA, Iran versus New Zealand. We're actually going to get a breakdown here on how that city is handling the world's biggest sporting event. Larry Freedman, co-chair of the LA 2026 FIFA World Cup host committee. He's going to join us a little bit later, right here on The Close, right here on Bloomberg.
SpaceX's third day of trading, putting Elon Musk's space machine on track to overtake Amazon in value. And take a look at that market cap, surging to around $2.7 trillion. Joining us live is the Dean of Valuation, Aswath Damodaran. He is Professor of Finance over at NYU Stern School of Business. Professor, great to have you with us. I was taking a look, of course, at your post-perspective blog post, putting a value on SpaceX. You ended up with an enterprise value of about $1.2 trillion, in equity value near $1.3 trillion. And as I just read, SpaceX, of course, is trading roughly double that in terms of its market cap. But walk us through what led you to those figures. You know, what were the different inputs rather, that led you there?
I mean, let's start with, I think, the big story here. This is about as close as you can get to the Avengers Stark Industries, a futuristic company that is in space. You look and say, that's what the future is going to look like. A space launch company that offers internet through satellites and now is in the AI business. It's an engineering marvel as a company, but it's still a company that has only 20 billion in revenues, is losing money. So the value is going to come entirely from what you think about its future. I mean, that's why when I valued the company, I said, this is my story, my value, my decision. But if you have a different story and a different value and a different decision, I'm not going to contest you and say you're wrong and I'm right, because how can I make that judgment? So it's a three-business company loosely tied together by outer space. But ultimately, all three of the businesses it's in are the businesses of the future. And it's in a pretty good spot in each of the three businesses.
I love that phrasing, three businesses loosely tied together by space. Let's talk about the AI piece a little bit more, because you kind of described that as really the swing factor when it comes to your valuation. And it seems like the AI factor there continues to swing. You think about the news we got today, SpaceX announcing that it has finally formally agreed to take over Cursor, for example, when it comes to its AI business. There's a lot of speculation about whether it could merge with Tesla. And I wonder, you know, you think about how quickly the AI story is changing, how rapidly does that sort of impact the valuation when you think about that AI swing factor?
And you're absolutely right. This is still a huge potential market where much is unknown. We don't know what successful businesses in the space will look like. In addition to what you mentioned, the fact last week that you had Claude Fable, and you know, those of you who've been tracking the news know that the US government has essentially suspended its use to non-Americans. So basically there is that news story. The other big news story less reported is that OpenAI is cutting prices, which tells you that this is a business where competition is going to be upfront, and the costs of delivering products and services are still a big unknown. I mean, I read somewhere that an hour of Claude Fable would cost you $6,000 as a company. You're saying that's good for Anthropic. They must be making a lot of money. Not necessarily. The cost of delivering AI products and services is also in turmoil. The power, the water, the other costs involved. So I think there's a lot in this business we don't know. And of the three businesses SpaceX is in, this is its shakiest business, but the one with the greatest potential. So you're right, it's a swing factor. People disagree on what SpaceX is worth. It's around AI that the disagreements are going to revolve.
Well, draw that thread then from the SpaceX AI business, obviously its lowest margin business of the three major ones under that umbrella, to Anthropic and potentially OpenAI, which hopefully when they come to market, we'll get more clarity on what they have. Is the future of AI, and more importantly, of the AI business model, not necessarily just in selling the time and the tokens? Is there sort of a bigger flywheel that maybe these companies might go after?
Yeah, absolutely. They have to. But their market caps, they don't go after the bigger flywheel, the value's not there. So the question is what that edge is. What's going to create the networking benefit in this business? It's going to cause somebody who picks Claude to stay with Claude, or picks OpenAI to stay with OpenAI. That's why I said this is a business very much in transition right now, where people are feeling their way, including the big players. It's not like OpenAI and Anthropic and xAI know what's coming. None of them do, which is one reason you see them trying things out, hoping that something sticks. Starting with, this choice of subscription versus usage models, where Anthropic has increasingly shifted away from subscription models to usage-based fees. Because it turns out that left in the hands of people, you can end up with incredibly large expenses from AI bots if you don't control them. So that's going to play out in the companies that adopt these AI bots, or AI agents. But I think you're also going to see it play out in the companies offering these products and services. But you're right. Ultimately, this is a big market. And the company that essentially ends up controlling this market could be worth a lot more than $5 trillion. I mean, you put the number on it. It could be a huge number.
Well, I am curious about
it. At the moment, we don't know which one it is.
I am curious, though, too. And obviously, I mean, you are basically the guy who teaches folks how to do traditional valuations. And I am curious as to whether the way we think of traditional, I kind of put that in quotation marks, but you take whatever the standard is out there. Does that even apply to this sort of future, particularly given there's so many unknowns about how this technology is going to be applied?
If by traditional valuation you mean looking at price earnings multiples or EV to EBITDA and saying this looks expensive, you're absolutely right. Those metrics are almost useless here. But if you ask me where does the value of a business come from, I don't care how futuristic you are. If I'm investing in a business, ultimately, I need that business to generate revenues, those revenues to be profitable, and to have cash flows left over for me as an investor. So no matter how futuristic a company is, ultimately it's got to show up in the brass tacks. The missing ingredient here is your imagination, because you can't just take past numbers and extrapolate them. You need to tell a story about the AI business, and that's why I said there's room for disagreement. If you think AI is going to replace every white-collar worker, and there are some people who do, your potential market is much bigger, and you will value LLMs and AI companies a lot more than I do. I don't think that's likely to happen. I think you're going to see a healthy subset of white-collar workers replaced. But I think those are the disagreements. They're disagreements about the big picture. What's AI going to do? What is it going to replace? Is it a tool or is it a people replacement? All those questions ultimately have to be answered for you to be able to value these companies. And right now, we're shooting in the dark. We don't have much information to base it on. But we can't use the excuse of it's too uncertain. I'm not going to make an estimate. You still have to make your best judgments, accepting you're going to be wrong 100% of the time.
All right, Professor. I have to leave it there. Aswath Damodaran, Professor of Finance over at NYU Stern. A closer look there at SpaceX. We'll be back in a moment. This is Bloomberg. All right, time now for our top calls. The big movers on the back of analyst recommendations. And we start off with Fannie Mae. BTIG downgrading to neutral, saying that right now doesn't look like they will be released from government control anytime soon, just not a near-term area of focus for the Trump administration. The share is down on the day. Next up, Dave & Buster's benchmark done with the game, seeing management's credibility deteriorated as it cuts its rating to hold from buy. Those shares down for a third straight day. And finally, let's take a look at Roku. Wedbush resetting its rating to neutral from outperform, removing the streaming stock from its best ideas list. The firm maintaining, though, its $155 per share price target, saying Roku is worth at least that much with the impending acquisition by Fox. Joining us right now to talk a little bit more about that is the analyst behind that last call, Alicia Reese, Senior Vice President of Equity Research at Wedbush. And Alicia, I want to start with something that you kind of made clear in your note here. You said this stock is worth $155 on a standalone basis. It doesn't need to be acquired to fully realize its value. And its beat and raise in the most recent quarter underscores accelerating monetization. So what's going on here?
Yes, so Anthony Wood, the CEO and founder, has a really great deal here, particularly for himself. He saw a way out at around 160, which I think anyone would consider as a reasonable price, although they could get more. But for him, he also got a board seat, a tax-free structure. And with 55% of the voting power legally committed to the deal, he just doesn't have any reason to walk away from it.
And I do also want to get your thoughts on a recent Semaphore report that apparently Netflix lost out to Fox in pursuit of Roku. It certainly turned some heads here. I know that you don't formally cover Fox here, but where do you think Roku is a better fit when you think about Netflix and the Foxes of the world?
Well, we did think of Netflix as a potential contender for this if this deal was to fall through, and we still believe that's true. I think the reason that Fox won was for the reasons I just noted. I don't think that Netflix would have offered the board seat or an ongoing position with the company necessarily, and I think it's very unlikely that they would have offered 40% of the company so that Anthony Wood would enjoy that tax-free structure, walking away being able to do that tax-free or at least tax-deferred. That's a particular consideration that Fox was able to provide that some of the bigger companies would have wanted to purchase all cash. And the shareholders, I think, would have appreciated that, and it probably would have been at a premium. But for the largest shareholder and voting holder, Anthony Wood certainly had to say.
I am curious as to what your general read is right now, Alicia, kind of on the state of streaming. Obviously, there's been a lot of talk as to why Fox is moving into this space, the idea that the traditional cable model is something they clearly have to find a way to sort of broaden out from. But Netflix is now, at least based on reporting, tried to bid for Warner Brothers, tried to bid for Roku, potentially, and apparently was also in the mix, apparently, on Lionsgate. What is this telling us about sort of where we are right now in this sort of streaming ecosystem?
I think this is a particularly favorable market for consolidation, the likes of which we have not seen for some time. This business is very expensive. Netflix is in a great position on its own. It can continue to drive organic growth, but why not accelerate that by not having to pay those steep licensing fees for third-party content if it can, lock down a studio and leverage that. Right. Lionsgate would present it with an opportunity to do so for significantly less regulatory and industry scrutiny than Warner Brothers did or would have. Roku, I think, would have been, another deal where there was a significant pushback because Netflix is the most used platform on Roku. And so, with a company like Lionsgate, I think there's a little bit more favorability there. Start small. But I think really it's Netflix's advertising that's, driving its future growth. Same thing for Roku. All of the ACR data that it has as an asset on the CTV market, it's got $5 billion in revenue, growing at nearly 20%. Mm-hmm. The advertising infrastructure, frankly, is just at the very early stages of realizing its potential and heading into performance marketing. That's where the world is going. Walmart saw that ahead of the game, right, and got Vizio. That's just where things are going. And right. Amazon certainly knows that.
Alicia, gotta leave it there. Hope to have you back soon. That is Alicia Reese. She is Senior Vice President of Equity Research over at Wedbush. Coming up, we're going to talk a little bit about the housing market. We'll do that with Chris Merrill of Harrison Street Asset Management. This is Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Katie Greifeld, keeping a close eye on that equity market, but also on the housing market as well, Romaine, because we got housing starts this morning. It was pretty ugly, especially when you think about the big plunge that we saw in multifamily starts.
Yeah, and this has kind of been the story. We've seen this sort of ebb and flow over the last few years, quite frankly. And the idea is that when we would finally see that breakthrough, but there are other pockets of real estate that I think are doing a little bit better outside of traditional single-family and multifamily housing. You're seeing that obviously in commercial real estate, offices, but also senior housing,
yes,
student housing.
Yes, senior housing especially is one that we talk about a lot on this show. And let's keep that conversation going now, because joining us live in studio, I'm pleased to say, is Christopher Merrill. He is co-founder and global CEO over at Harrison Street Asset Management. That is a $109 billion asset manager, and the largest private owner of senior housing in the U.S. Chris, first off, great to see you.
Great to see you. Thanks for having me.
So I do want to talk a little bit about the environment that we're living in right now, because you think about what we saw when it comes to housing starts today. A lot of that can be tied back to mortgage rates and the idea that we have a Federal Reserve that looks sort of stuck in place. It seems like the consensus is they won't be able to move in either direction on interest rates for the foreseeable future. How does that factor into the sectors where you're most involved when you think about senior housing, but also things like student housing as well?
Sure. For us, we've been at this, as you know, for 20 years. And really the focus for our business has not been on sort of macro. It's really been on the demand side of the equation. And so for us, investing in areas around education and healthcare where demand is consistent, good and bad times, has really been our thesis. And for us, that's student housing, senior housing, medical properties, self-storage, where they're very strong, resilient asset classes that we've really invested through many cycles.
Well, I do want to talk specifically about student housing because recently you sold a 12-property portfolio for about $910 million. And you talk about how you focus on demand. It's not necessarily the macro. When it comes to higher education, there's a whole bunch of cross currents swirling there. You hear the odd story about, certain colleges and universities having to shut down. And I just wonder what the past couple of years have looked like in that sector.
Yeah, absolutely. I mean, student is certainly one that's of interest. And when you look at enrollment, the picture for certain schools is much better than others. So for us, we focus on public universities where we're actually seeing, growing enrollments. You're absolutely right. Of the 4,000 schools, you're probably going to see 15 to 20% actually go out of business. So it's very important in this asset class to focus on the schools that you believe are going to be the enrollment takers. And for us, having done it now for so long, we've invested over 200 universities. The real focus is on these schools that really have these great long-term demand drivers, where really only 15, 20% of the kids can be housed on campus. So really developing an off-campus business is very important. We've also got a new business now. We're actually working with a lot of these schools in public to private partnerships.
I am curious, though, about just the acquisition strategy in terms of getting the land, the properties, et cetera, and this with regards to student housing, because I've always been under the impression that the areas around these schools typically tends to be somewhat competitive. In fact, some cases, I would think you're competing with the school.
Yeah. It's interesting. I mean, what we've done with our models, we work with local developers all over the country, and that's a way for us to get scale. So for us, we're not taking that risk of entitlement working through the pre-development. We're going out identifying great developers in the Southeast, the Southwest, the Northeast, working with these groups doing investments one at a time. And then what we do is we build portfolios. So 80% of our investments are individual asset investments or developments, but 95% of our sales are portfolios. As you're seeing a lot of these big institutions that want to get into the space, we can accumulate and put together these portfolios as we just did and sold. And so for us, we've probably sold 8 to 9 billion in these demand-driven asset classes in the past 24 months. Big focus for us, DPI. DPI is the new IRR. We want to give money back to our investors.
Does a higher interest rate environment to a certain extent actually help you? I mean, I don't know, maybe not on the development side, but certainly on the return side.
It's actually a great point because what is happening, development's very difficult, right? So supply has been choked off. So for us, the higher rates, inflation, we're in asset classes that can reprice. We can reprice them on a monthly basis. We can reprice them on an annual basis. So these are great asset classes that you want to be in over a long period of time.
And you mentioned that, DPI is your focus right now. And that was sort of what I was wondering when you think about, the different sort of transactions you've executed, selling, of course, some of these parts of your portfolio. Where does that leave you when it comes to, acquiring more assets? What's your current appetite there?
It's interesting. So, we've got a business that has open-ended funds and closed-ended funds. So we're always looking at selling within the closed-ended funds. But we're very active on the acquisition side as well. So we've been very active over the past 3-4 years, really acquiring assets and developing. So the nice thing about our business is we have capital really across the stack. We have capital to develop, we have capital to acquire, and we also have a very big lending business. And so really that's allowed us to participate in the cycle. Again, when we look at it, great vintage, great time to be investing. It's not about timing cycles. This is really about infrastructure and the needs for infrastructure in our economy.
Is there any worry, though, about increased competition with regards to investors looking for alternative assets?
Sure.
Obviously, I think to a certain extent, I would think real estate had a bit more of an advantage, certainly in the areas that you're in, compared to some of the other, middle market type lending and manufacturing space. But they do appear, that side of the market appears to finally kind of maybe be righting itself.
Absolutely. I mean, when we started the business, 1% of the market was, the liquidity was in alternatives when we started 20 years ago. That's up to 15, 20% now. So there's a lot of interest in alternatives now. The challenge is access. How do you access the space? You're not seeing the larger groups doing one investment at a time. They don't have the relationships that we've developed for 20 years. So for us, it's important to stay disciplined in how much capital we raise so that we can be the manufacturer of these portfolios for the larger groups. So increased liquidity is adding, great opportunities for us right now.
And Chris, I do want to talk specifically about senior housing because as I mentioned in the introduction that Harrison Street is the largest private owner of senior housing in this country. And, it's a narrative we've heard before that you think about the graying of America, the fact that there's a lot more older Americans than there used to be, and it's projected to increase as a share of the population. Is the story that simple, or what nuance are you seeing there?
Sure. It's never simple. There's always nuances. For us, we focus on sort of that independent, assisted memory care part of the portfolio, private pay rental model. But, step back, 80,000 people turning 80 every month. When you look at 85 plus, almost 1/3 of that population has some level of dementia, some level of memory issue. People living longer, very hard to take care of a loved one with health and memory issues. The big issue is the supply isn't there. So we're going to wake up in 3, 4, 5, 6 years and be so undersupplied in this segment. And so really that's where we think, yes, there is an opportunity. But you need to be in the right market with the right partner in order to make sure you provide the right quality of care for these seniors.
And final question, and this is more just a personal question. You're based in Chicago.
Yes, sir.
You started this business with Chris Galvin, who kind of helped fund it, the former CEO of Motorola, a great Chicago area business. I mean, what is the business climate like in the greater Chicago area right now? Yeah,
that's a great question. Yeah. How much time do we have? But no, let's first off, Chris Galvin was my mentor and really gave us the capital to get the business started. And I pinched myself that I had that opportunity. Chicago is a wonderful place to build a business. It is a great climate. We have a great, workforce. We're recruiting from schools like Wisconsin, Indiana, Purdue, Illinois, Northwestern, great universities, great health systems. So Chicago is a wonderful city to really build a business and raise a family. What we've been trying to do is in our own way invest in the city. We can do it through investing with schools like University of Chicago. We can invest with hospitals like Rush and Northwestern. So the beauty of our model is we can invest in these demand-driven asset classes. So certainly there's some challenges politically right now in the city, but it's a city we love and it's meant a lot to us. So we're trying to do our best to invest and give back.
All right, Chris, appreciate the candor. Chris Merrill there, co-founder and global CEO of Harrison Street Asset Management. When we come back, we turn back to the public equity markets and take a look at shares of Yum Brands as the company plans to shed Pizza Hut.
Oh, no.
Yes, that's coming up next here on The Close, right here on Bloomberg. Time now for our stock of the hour. Taking a look at shares of Yum Brands moving higher as investor appetite for the restaurant operator grows after it agreed to sell off Pizza Hut to the private equity firm Long Range Capital. Nora Melinda joining us right now to talk a little bit more about this deal. I am curious about this. This was their smallest business. I mean, obviously, KFC, Taco Bell, probably the more well-known businesses. Pizza Hut, it's legendary. Why are they selling this?
Used to be. Hasn't been doing so well in recent years. If you look at the share of revenue for Yum Brands, Pizza Hut only made up about 12% in 2025 and has been seeing a steady decline since 2019. I mean, I used to go to Pizza Hut way back when there was the arcade in the front.
Yes.
People aren't really going anymore. They say no one out-pizzas the Hut, but clearly some people are because Domino's is apparently doing better. Domino's out-pizzaing the Hut, and people are going to Domino's. They're doing better with tech, promotions. We know that this is a really high promotion environment.
Avoid the Noid. Was that Domino's?
Avoid the noise?
Yeah, the Noid.
I have to say I have no idea what that is. Yeah. I do love Domino's.
We're going to go off the rails here.
Off the rails.
It was Domino's.
They said avoid the Noid?
The Noid. It was a very popular ad campaign.
What's the Noid? Is that like the
what
void?
Is that?
It was like a little creature that was.
Oh,
that sounds scary.
That sounds kind of cute.
Yeah, there you go.
Let's talk a little bit about Yum,
I have no idea
though.
what it had to do with pizza.
So Pizza Hut, as you say, it's seen better days. Where does this leave Yum's position? What are analysts and people on the street saying about what basically this means for Yum?
Well, this was removing a weak performing business. When you think about the others in the brand, you have KFC, that's the largest brand that they have. Taco Bell, Habit Burger, I'm not familiar with that one, but that's also accounts for about $570 million worth of sales. Pizza Hut not doing too well, of course. So you are seeing analysts, also Wall Street, clearly celebrating the idea of them removing Pizza Hut from their portfolio. They did see some pretty strong strength in China, so that's why you see Yum China purchasing Pizza Hut.
Yeah.
Popular there, maybe not so much here in the U.S.
Do you know anything about Long Range Capital? Because I looked them up. First of all, I think it's interesting. They own 24-hour fitness, so I don't know if this is like an arbitrage play or
Fitness, pizza, sure.
Yeah, why not? But it gets to this idea of, and we should also point out that Yum China is also part of this deal
Yes.
as well. So this isn't completely going to long range. So it does seem there is a geographic issue here too, where maybe they think they can do a little bit better.
Must be. I mean,
overseas.
Yum China is saying that Pizza Hut is the largest casual dining brand. I mean, of course, when you look at a lot of these statements and everything, people are going to say what makes sense for them, but apparently it's very popular over in China.
Cultural.
But here, it's not really inviting. People find Pizza Hut a little bit on the dingier side, not really a welcoming environment to sit down. Arcades, don't know if they're still there.
A lot of memories.
Yeah.
Free refills.
A lot to think about here when it comes
Cinnamon
to this
sticks.
specific deal. I do love the idea that Long Range Capital is sort of diversifying their portfolio with Pizza Hut and 24-Hour Fitness. Nora, Melinda, great reporting as always. Yum shares marginally higher today. Coming up, though, it's the closing bells. We're going to take you there and walk through the market action with Kristina Hooper. She is Chief Market Strategist over at the Man Group, and she joins us next. This is The Close on Bloomberg.
Just about 10 minutes until we get to the closing bells. Romaine Bostic alongside Katie Greifeld. The three-day rally that we had on our hands, taking a bit of a pause here on this Tuesday afternoon.
Yeah, absolutely, especially when it comes to big tech. You take a look at the biggest losers in the S&P 500, at least on a points basis, NVIDIA, Broadcom, Micron, AMD. So a lot of those chip makers that had been flying high, it's hard to make too much out of a single day when you think about the tear that we've been on over the past couple days, and the fact that we have a lot of interesting events on the docket. I'm talking specifically about Kevin Warsh taking the stage tomorrow at the helm of the Federal Reserve at his first press conference. Who knows how much monetary policy thinkings right now are influencing this market, though.
Well, it'll be interesting, too, because when he takes the stage, obviously, you know, the statement probably isn't going to tell us a whole lot. We're not expecting a change. But, of course, every question is going to be about kind of how he wants to reshape the Fed. Is there going to be a dot plot? Is there going to be forward guidance? Is he still going to do press conferences?
Who knows?
These are things we want to know, Katie.
Absolutely. I mean, you think about the every meeting having a press conference. That was a Jerome Powell invention. It's only been around since 2019, so who knows if he'll revert.
Yeah, we'll find out. With Kevin Warsh area already underway as that two-day meeting in Washington is underway with, of course, the Fed decides starting at 2 p.m. tomorrow right here on Bloomberg. Joining us now, though, in Studio 2, counting us down to the closing bells, is Kristina Hooper, Chief Market Strategist at Man Group. Kristina, great to see you.
Great to see you, Romaine.
I do want to start kind of with the macro picture that Kevin Warsh is walking into. I mean, you know, set aside the potential that we might have an Iran deal, and that's putting downward pressure on energy prices. But he's walking into still a relatively inflationary environment and still a mixed environment when it comes to economic growth, or at least the complexion of that economic growth. So what does that actually spell for the potential for any shift in monetary policy anytime soon?
So my view is that the FOMC is going to be far more concerned about inflation than any signs of weakening growth. And so they do have the luxury of saying we're going to take a wait-and-see approach because we do have this deal in place. But I believe they're going to have to eliminate their easing bias. I think they're going to have to talk about what could potentially trigger a rate hike, and I think we could easily see a rate hike this summer. To me, this is an environment in which I'm sure he'd like to ease, but I think it's going to be incredibly hard for him to ease, especially given the last jobs report. Let's face it, that was strong. Now, I do see some cracks. I've talked a lot about the cracks I'm seeing in the economy. Places like, for example, the most recent small business optimism index. In there were a lot of concerning survey responses. But what he's inheriting is largely a picture of a robust economy with inflationary problems.
But when we talk about the robust economy, I know there's been a lot of hate made over the K-shaped economy. And let's just take oil prices as the barometer. I mean, we were below $70 a barrel prior to the war on WTI crude. We got up to 112, 113. We're back around 76, 77 today. I know that doesn't directly translate into relief for the consumer and at the pump immediately, but over time, if we do start to see some of the energy price pressures come down, I know that still a lot of issues with food and other things. Does that have an economic impact?
Certainly it has a positive economic impact, but the reality is there are a lot of forces exerting downward pressure on middle and lower income consumers. So this is not the be-all and the end-all. We are relying almost entirely on high-income consumers and their spending. The top 10% are responsible for about 50% of the spending. So that's a vulnerability, a built-in vulnerability, if something happens that could derail their level of spending.
And Kristina, I want to go back to what you're saying, that, you think about these different cross currents, especially when it comes to the inflationary landscape here, that the Federal Reserve could be forced to hike this summer. The bond market, it seems to have been pricing in that possibility. But how do you think that would land in the equity market? Because, again, prior to today, it was just off to the races in terms of enthusiasm here.
So I think the equity market recognizes that that is a very real possibility, and we haven't seen a negative reaction yet. So it could very well be that if we have a situation where it's a very, very modest tightening, that the stock market will not react negatively. I do believe, though, that if we were to see multiple headwinds at the same time for the stock market, so downward earnings revisions at the same time that we see even one hike, that could be far more problematic.
What do you think that means for, the broadening out that we've seen when you think about the fact that the equal weight S&P 500 is still outperforming the market cap weighted index? You think about the Russell 2000, your small caps also outperforming as well. Does that look precarious in that sort of environment?
I do think there's more risk in that kind of environment. And, keep in mind, the tech names have really powered the stock market for much of this year. So there's a real potential that they could also experience a pretty significant hiccup. The Strait of Hormuz might reopen and a lot of commodities can pass through. But there's going to be a lot less helium passing through because of the infrastructure destroyed in Iran's bombing of Qatar facilities.
I am curious, so on the AI front, there's been a lot of talk about, how stretched the trade is, but also a lot of bulls who kind of say, look, we're still at the relative infancy of whatever AI is going to be. There was a great survey out, the Bank of America survey, kind of talked about with their clients. We're still kind of looking at this as being in the boom phase, as meaning a positive and not necessarily that euphoria phase here. I know it's a huge concentration of our market and of our economy right now. Is that necessarily a bad thing in the short term?
It's a double-edged sword. It's a good thing when it's working well, and it's a bad thing when it isn't. And I do think there are vulnerabilities. We are seeing investors becoming more discerning, more concerned about sources of financing, and certainly less likely to finance certain projects. We've seen CDS swap spreads. They've expanded because there is more concern around certain hyperscalers, the amount of money they're spending on this, and concerns that they won't see a payoff, at least not fast enough. So I think there are many parts of the AI CapEx food chain that are doing very well, but there are areas that are, in my opinion, not doing as well and are subject to far greater scrutiny by investors. And that's part of the maturing. I know it's a long process and we're in early innings, but that's part of the maturing of this industry.
All right, Kristina, I have to leave it there. Kristina Hooper, Chief Market Strategist over at Man Group. And Katie, we're keeping an eye on the markets. Also keep an eye on Oracle. The shares are taking a bit of a leg down here, down about 2%. This on the back of a Business Insider story that apparently Microsoft had been negotiating a $3 billion data deal with Oracle, but they backed out of it because of what they're saying, security and compliance issues. Basically, Microsoft was going to move its workloads to Oracle Cloud infrastructure.
Right.
But according to that reporting, that deal appears to have been scuttled.
Yeah, absolutely. You're seeing that stock reaction right now. And again, this is according to insider reporting, Microsoft walking away from a potential $3 billion deal there.
All right, quite a few stories here on this Tuesday afternoon with stocks on the back foot. A full breakdown of all of today's market action with our global simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube here. I guess we'll call this a bit of a pause, Carol Massar, in that three-day rally with the S&P, the NASDAQ, and the Russell all in the red.
Yeah, it's kind of interesting, right? Yesterday we were higher on the S&P 500, but if you went inside the index, we kind of had an even split between gainers and decliners. Well, now we've got the S&P down, and the same story. You've got about half of the names higher and half of the names lower. It's just kind of the trade that we're in. Maybe we're just all waiting for that Fed decision.
Fed decision, but also waiting for the latest out of the Middle East, and with a memorandum of understanding, the details of that, at least according to our Bloomberg News team, becoming clearer and clearer. Taking a look at oil right now, Brent still down about 4% today. WTI down 4.8%. Both of those still above $76 a barrel, but getting closer and closer to those not quite pre-war levels.
Yeah,
closer.
Get it there.
We'll see if they have.
I've been
Sorry,
waiting to fill up my gas tank for like 2 months.
Jeez Louise.
what did you say? You haven't filled up your gas tank for 2 months?
How are you getting around?
That's because you live in New York.
Oh,
but it's also because
the chauffeur.
Yeah, I was going to say it's also
you
the
don't have to
chauffeur.
worry about things.
Romaine, I saw some great Knicks gear this morning.
Oh yeah,
on the way to the office.
They were selling just a block.
Official,
even down.
Oh,
yeah.
Officially cool. Definitely not official from the NBA's perspective.
Did you buy any?
I almost bought something for Romaine. I should have done it.
Almost. Wow.
Okay.
Gee, thanks, Joe. You're almost my friend. All right, we get the closing bells here in New York. And I do want to just bring your attention here, too, because we talk about the red on this screen. There is one big exception, and that's actually the Dow Jones Industrial Average, adding more than 300 points on the day, or about 0.7%, to close out at another record high. And a big part of the reason is we saw a lot of strength today in material stocks. We saw a lot of strength in financials, including JP Morgan, which was up 4% on the day. Unfortunately, we did not see a lot of strength in tech stocks, and that's a big part of the reason why you see the S&P down about 40 points or 0.6%. The NASDAQ composite down about 1.1%. The NASDAQ 100 down almost 2%. And as for the small caps, which, believe it or not, are tilted pretty heavily to tech these days, that closed lower by 26 points or 0.9%.
All right, that is your overview. Back to the S&P 500, 273 names. Katie, in that index, higher today, 230 to the downside.
Let's take a look at the circle and take a look at the sector performance, because there was more green than red just in terms of the number of sectors managing to finish with gains, 7 in total, 4 in the red though, and one of them was very important. That is information technology. You can see that's that big red slice, down about 2.3%, outweighing the 1.5% gain you saw in financials. JP Morgan in particular had a great day. Utilities, industrials also gaining today. But again, we think about the index math. When you have tech declining to that degree, it's going to be very hard to see the overall index green.
All right, guys, let's go to some of the individual gainers, if I may. Got to talk about SpaceX. Up for a third day in a row since that IPO on Friday, adding about another 5%, actually 4.8% if we want to be exact. The stock, though, was up as much as 17% earlier in the session, so finishing way off that high. We're talking about, what, a 20% gain yesterday, and then on Friday we had more than a 19%. So we have seen certainly some big moves. A lot of trading activity, but nonetheless the gains getting a little bit smaller here. Some news, though, SpaceX agreeing to take over Cursor in a deal that values that startup at $60 billion. It's all part of Elon's efforts to catch up with rivals on coding tools, because that's what Cursor is all about. So, yeah, that is something we're keeping an eye on. I want to go over to two names, Western Digital and Seagate Technology. Western Digital, your number 3 gainer in the S&P 500 with a gain of more than 4%. Seagate was the number 2 gainer in the NASDAQ 100. It was up about 1.25%. These two have been on fire this year. Western, we did see hit a record intraday, and it may have closed at a record as well. I'll bring it up on the Bloomberg. In the meantime, both yesterday, Morgan reiterated overweight ratings on the hard drive makers, Western Digital and Seagate, bumping their price targets for Western to $650 and its Seagate target to $1,000, $1,035. The analysts there calling the stocks his most favored overweights. I should point out Seagate is up about 280% year to date. And then you've got Western Digital up about 300% roughly year to date. So they have been on a tear. Want to go over to Moderna. This was your number 2 gainer in the S&P 500. That stock was up about 6.25%. Couple things going on The FDA released briefing documents on its influenza vaccine that analysts say may signal a favored outcome. And then you also had the company reporting organizational changes to get ready for some product launches over the next few years. The company's president assuming expanded operational oversight of leadership across R&D, manufacturing, and commercial for the company's 3 franchises. So again, a lot of news out of that one. That stock too is up I think almost 90% year to date, with about 16% of the float is short. And just, sorry, I'm a little bit of a hog today. I'm going to go over to LUV, Southwest Airlines. I know stock is up.
To the good ones. Can I interrupt? So, did you take a look at Lionsgate today?
I did not.
Yeah, they closed at a record high. In fact, having their best day in months, up 79% this year. This on the back, Carol Master, of that report by Semaphore. It was actually more about Roku and Netflix's apparently interest in trying to buy that company, but they also dropped the interesting nugget that it had apparently been interested in Lionsgate, the movie studio, as well.
Yeah. Well, this is why this is why we have you, so you can interrupt and add in some stuff.
Roman, I don't know if you were listening to our show earlier, but Roku actually started inside Netflix.
I do.
Almost 20 years ago.
I do remember that.
It's kind of crazy. They spun it off, and they had a big investment in the company.
I know. Yeah.
Time is a flat circle, you know.
I love talking about Lionsgate when Southwest Airlines.
Oh, sorry, Carol. Go ahead. Southwest.
Just going to say.
Do we have some decliners to do?
I'm just going to tell you that when it comes to Southwest, Jefferies analyst Sheila Kayalu maintaining it with a hold, raising the price target from $37 to $44 a share.
Okay.
All right.
That was worth it.
Yeah, I thought so.
I'm going to go fast. I want to talk about some of the exchange operators here. And what's happening? Look at this. SIBO Global Markets fell 9.5% today. It's actually biggest decline, or lowest level rather, going back to February 2nd of this year. CME Group also down by 1.7%. These exchange operators fell after CFTC chair, I should say, Michael Seelig defended the recent regulatory approval of crypto perpetual futures. The CFTC permitted the listing of perpetual futures on U.S. exchanges. That was last month. It was May 29th. Seelig said it's time to approve regulated futures contracts that have no expiration date. The concern here is that regulated perpetual futures could be a substitute for index option speculation that SIBO monetizes. Investors had that concern today, sending shares of these exchange operators down today, but SIBO falling more so than CME Group. I don't see any of you wearing Snap's new glasses.
No.
Did you hear about these specs?
I did hear about these specs.
Okay, augmented reality glasses.
Yeah.
$2,200.
$2,200.
Okay. Co-founder Evan Spiegel describes as a leapfrog advancement in the computer of the future. They have advanced displays, cameras that enable augmented reality, allowing users to run apps and third-party software, play games, and receive notifications, overlaid on the real world through transparent lenses. Snap shares closed down by 9.6% today.
Do you remember the old Snap glasses?
I do, yeah. Those were specs also.
Yes, they were. They weren't $2,200.
No, but you know what's funny is they were the precursor to the Meta glasses that are somewhat popular nowadays, but Snap had them before.
Yeah.
And they never caught on.
Yeah, our senior producer wears those to spy on us.
Okay.
I'm always careful what I say around her.
I know I'm surrounded by some cat people and some dog people, so I want to go to Tractor Supply.
Please.
This is a really interesting story here. Okay. Tractor Supply shares ended up falling today by a little more than 2%. The farm store chain was downgraded at Truist and Piper Sandler, cited concerns about competition and a falling large dog population that reduces the company's total addressable market.
What?
Yeah, exactly. So large dogs have been Tractor's bread and butter and key traffic driver. This is according to a Truist analyst.
Okay.
He wrote in his notes, the concern is that if people have fewer of these large dogs, then they will go to Tractor Supply less frequently.
Okay. That's interesting.
I got Carol's a dog person. Romaine, you're a dog person.
I have a small dog, so.
Katie's a cat person.
Thank you.
How big is your cat, Katie?
He is 9 pounds.
No, that's kind of small.
Carol, do you have a big dog or a small dog?
I have one of each.
Okay. Excuse me.
All right, that's Tractor Supply.
What's kind of a COVID dog?
Shares down by about 2% today. What else you guys got?
Yields. Do you care? They're down.
I care.
Basically about 1 basis point on that 2-year yield, which of course is the thing everyone wants to keep an eye on as that 2-day Fed meeting is underway. Of course, the decision will drop at 2 p.m. Eastern time, a statement. The market not expecting any changes, but obviously it's that 2:30 press conference that will enwrap pretty much everyone around the board. And of course, we'll have full coverage right on Bloomberg starting at 1:30 p.m. Eastern time.
And if you hadn't talked so much, we could have talked about Froyo.
I was dying to talk about Froyo, but
Okay.
we'll have to save it.
Just saying.
We're gonna
Is it
miss
back?
you. We're gonna miss you guys tomorrow.
It's like TCBY.
You guys aren't here tomorrow either?
No,
Where are you going?
we're going to Las Vegas.
We're leaving on a jet plane.
Vegas,
Don't
fine.
know when.
On Fed Day?
Wow,
I just-
gonna go gamble.
Jeez Louise.
Yeah.
He's a high roller. I don't know if you've ever.
Me?
Yeah.
No. I just found out that Carol and I might be sitting next to each other on the
Do
plane.
you know what
That's a
he did?
nightmare.
my
He
gosh.
just made me change my seat.
Yeah, change,
Okay.
That's fair.
change.
It's a long flight to
Tim,
Vegas.
if you got to go to the last row and coach, just do it.
No, can't say anything nice and not going to say anything at all. All right, that's a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell.
You know, I sat next to
Katie and
Mikey G on the
Romaine
flight once.
talking-
We didn't talk at all. It was glorious.
Non-stop talking.
It made me respect them.
Goodbye. We'll see you. No, we won't see you again. Same time, same place tomorrow.
Bye.
Bye.
And our coverage continues here on Bloomberg Television as the FOMC kicks off that two-day policy meeting. A breakdown with Jay Barry when we come back after the break. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic as we close out the market day here on this Tuesday afternoon. Red on the screen for most of the major indices, with the S&P pulling back by about 43 points, or roughly about 0.5%. We should point out there was still a bit of a rotation underneath the surface. In fact, it's not on the screen, but the Dow Jones Industrial Average, believe it or not, actually closed at a record high. And a big part of the reason is for that third line on the screen, the KBW Bank Index up about 1.6%, believe it or not, to a record high. Gold getting a bid for a fourth straight day as a lot of people start to price out, Katie Greifeld, some of those inflation expectations as oil prices continue to drop.
Absolutely. Well, I want to go back to the Philadelphia Semiconductor Index because NVIDIA was your biggest points contributor to the downside when it comes to the S&P 500, leading the chip names lower, down by about 2.4%. SpaceX, though, another good day for SpaceX. Shares rallying nearly 5%. I believe we're now looking at the fifth most valuable company in the world today. That run continuing. And CoreWeave also having a good day, popping by about 10% after an analyst said that this company is woefully undervalued. So maybe a little bit less so after today. But let's get to our top story this hour, and that is less than 24 hours until the Fed rate decision as Kevin Warsh takes center stage. The central bank expected to hold rates steady as investors turn their attention to the new Fed chair's first post-meeting presser. Bloomberg Economics expecting Warsh to break away from the eras of Powell, Yellen, and Bernanke. Unlikely, Romaine, to submit his own dot to that closely watched dot plot.
All right. Well, maybe our next guest can submit one for him. Jay Barry joins us right now, head of global rate strategy at JP Morgan. All right, Jay. I mean, no one's expecting any change in rates tomorrow, but I think the communication we're going to get is probably, or at least we hope, the market hopes, will probably maybe provide some clarity about the potential direction for rates. Do you think we get that tomorrow?
So I think the April meeting, Romaine, teed up the likelihood that the Fed will lose its easing bias tomorrow. Because certainly the three hawkish dissents that we got then indicate that was a risk. Since then, a number of regional bank presidents and governors have come out as well. And in the interim, the labor market data has strengthened. So I think it's pretty clear that the Fed is ready to lose that easing bias in its statement. But there's still a lot up for debate between the summary of economic projections, the press conference, and frankly, just the overhaul of the statement itself as well.
Well, what does the trading look like or tell us with regards to in the Treasury market? Tell us with regards to how investors are viewing the potential moves or maybe lack of moves, and draw that distinction between what we're seeing on the longer end of the curve versus the shorter end of the curve.
Well, I think you look at the front end of the curve, and it's repriced sharply over the last few months. We're pricing in about a hike over the next year, really coming in early next year, which is actually consistent with our forecast. We ultimately think the Fed will have to hike because the rebound in the labor markets that we're seeing will ultimately mean the tension in the Fed's dual mandate is sort of gone. It will force to take back some of the cuts from last year. But at the long end of the curve, we don't think we fully sort of repriced to reflect this new dynamic. And actually, in our valuation frameworks, it seems like the intermediate sector of the U.S. curve is probably trading 20 or 25 basis points too low in yield. So even amid this decline in oil following the supposed resolution to the conflict, it seems like the long end is not fully repriced to that, or repriced to the more hawkish direction that we've seen from other central banks across the rest of the developed markets as well.
So it's interesting to hear that you see maybe the ingredients that could lead to a Fed hike. You're not alone in that. Still, Securities also see the risk of the Fed starting hiking in September. But we also heard from Andrew Hollenhorst of Citi earlier on Bloomberg TV saying that they're sticking by their Fed rate cut call. They think that the labor market is going to weaken here, and that you could still see 3 cuts this year. Starting in September. And I just wonder, how you're thinking about the labor market. Obviously, nothing to scoff at right now. It's been very, very strong. But what do you see as the trajectory, especially when you sort of weigh that against the other side of the mandate?
Yeah, I think our view has been the weakening we saw in the labor market last year was related to business confidence and uncertainty following the tariff shock and not related to AI and labor markets. And that there should be a recoupling between that and growth. And we've seen that. The pace of employment demand this year has averaged over 100,000 per month. And the unemployment rate hasn't come down, but the participation rate has gone back up. So we think that there is some cyclical rebalancing happening here, which will ultimately drive the unemployment rate a little bit lower. And we think, again, next year result in hikes. So that plus the fact that continuing claims has come about 10% off its peak suggests to us that the labor market should no longer be the dominant concern for the Fed. And if that's the case, going to a balanced set of risks is more appropriate.
And with that as your base case, I wonder how that affects the flow of money around the yield curve. You mentioned, when it comes to the intermediate slice, you think about the long end, there's still some room to reprice there. And it just seems like the front end and, of course, money market funds have been an absolute hotspot for cash. That has been the case for years at this point. The idea was that maybe once we get these cuts really starting, this cutting cycle, that you'd start to see some of that cash creep out. But it doesn't sound like that's necessarily going to happen.
No, and I think it's been our firm view that typically it takes the Fed cutting below 2% to see money flow out of money market funds into other asset classes, whether it's equities or the long end of the curve. And even with the shallow cuts we had over the last couple of years, that was going to be an impediment. And to the extent that money market funds are still offering a pretty sizable pickup over bank deposits as well, that was going to reflect an impediment. And the reduced likelihood that we go back to the zero lower bound probably means that money market fund AUM is just going to remain sticky. And in fact, we think AUM can actually drift a little bit higher over the course of the year as well. Really?
Weren't you talking to Rick Reeder earlier this week?
were,
Wasn't
you
he
know.
saying all that money was coming out of those funds?
Yeah, his thinking is that, that's money that is going to fuel an explosive rally as some of that cash gets unlocked. But it's not clear, and it sounds like Jay agrees with this, that that money necessarily belongs to risk assets, that it's going to recycle there.
It does raise the question, though, about kind of where the safety is these days. And this is more the cross-asset look here. I mean, do treasuries still serve that function?
I think they do, Romaine, but I think it's really depends on where on the curve you are. And we started to see this negative correlation between treasuries and equities start to take hold again last year as we began to enter this disinflationary environment. But now with core inflation back above 3%, I think it's harder for us to see that negative correlation. So I think you've got that, but it's more at the short end of the curve than at the long end. And I think it only reasserts itself if you actually think we're going to go into recession and you need a hedge to that for your risk asset part of your portfolio.
I would love to get your thoughts on the idea that's out there that as you start to see some of these huge big tech companies come into the corporate debt markets and issue debt, that maybe that will start to maybe crowd out treasuries. You think about NVIDIA, for example, yesterday raising $25 billion in their first bond sale in 5 years or so. Certainly feels like a sign of the times, and I wonder whether or not that theory holds any water.
So I think we see that deficits as a share of GDP and debt as a share of GDP matter for credit spreads. That adjusting for the credit cycle, Katie, it actually means as there's more debt to GDP out there, credit spreads should be narrower. And then we look at the shape of the debt that's come to market with these hyperscalers. It's actually raising the average rating of the IG universe. So it actually closes the gap between that and treasuries. And we've made the case that there's just not this same latent demand for longer duration risk-free assets anymore, because pension funds are well funded. So if you've got a spreadier option in the form of a very high quality, high grade corporate, it makes more sense to go there than it does go to treasuries.
But hasn't that corporate side, hasn't that become kind of the longer duration bet to a certain extent? And I mean, I talk to so many people and they say we learn more right now about the overall rates market by looking at what's going on in investment grade corporates than we do in treasuries.
Well, I think the thing there is just spreads as a share of all-in yields are just so low right now, Romaine, that basically you see rates markets reality is reflected through the credit market pretty quickly because we're still in a pretty, at least according to our colleagues in credit, a pretty benign part of the credit cycle as well.
That's a good point. You get along with those colleagues?
Yeah, I do.
All right. Jay, really appreciate your time coming to studio for us. That is Jay Barry. He is head of global rate strategy over at JP Morgan. Now coming up, Brent falling below $80 a barrel for the first time since March. We're going to discuss the latest leg lower in oil next. This is The Close on Bloomberg.
It's going to take months and not until the end of the year. Let's say the ceasefire, it works as planned on Friday. It would be probably by the end of the year you could even begin to talk about a resumption to normality.
Yeah. That was Jeff Currie, executive co-chair of ABAX Markets, warning that a return to oil market normality will take months, even in a best-case scenario. This as Brent falls below $80 a barrel for the first time since March, as the U.S.-Iran deal boosts expectations for a revival in supply. Bloomberg's Will Kobzanski, covering the commodity space. He joins us now. Will, I'm going to get your name right next time, but talk to us a little bit about the different dynamics here. I mentioned supply. Is that the main driver behind this big drop that we're seeing?
For sure. The market is pricing in a rush of supply coming through the Strait of Hormuz right now. That supply has not shown up yet, obviously. The deal is not going to be signed until Friday, but right now traders are thinking there's a lot of oil coming from the Middle East that's about to be released into the world.
So, I mean, how do we track this, though? I mean, my understanding is that you already had tankers out there that were already laden and ready to go, and assuming they can get through passage. Are there empty tankers ready to go in?
There are tankers positioning to go in to be the ones that take out those shipments. But, you know, first clear the Strait and then you need tankers to come back in. And it's also about restarting production, right? You need to load those tankers. The idea is to get a steady flow back, not just to clear out the backlog that's built up over 3-4 months.
Well, I do want to talk about the past 3-4 months because, I mean, you think about Brent in particular, we did get to some pretty scary levels when you think about absolute prices above $120. But, I mean, there were calls out there for $200 a barrel oil, really sort of an oil apocalypse some people were calling for. It never quite materialized. I mean, prices had been coming down kind of steadily for the past couple of weeks. So why did we never get to some of those scarier levels that people had maybe theorized about?
I mean, this is a question the industry is asking itself that analysts and banks are wondering. The main theory is, one, China ended up cutting a lot of imports. They used to import a lot of oil. They stopped doing that when the prices went through the roof. There's also the fact that the U.S. basically became the oil exporter of last resort for the rest of the world. And so suddenly you have all these barrels out there that maybe weren't coming out of the Gulf Coast previously. And then there's this idea that, you know, demand maybe fell in places here and there, and you know, the market responded to Trump's repeated declarations that we might be coming to an end of the conflict.
So when we talk about kind of this, not quite a round trip in oil, I mean, I think we were, around like $67 on WTI prior to the war. But, I mean, there was this idea that we were going to, you know, hit, you know, $200 a barrel or something really crazy, and that never materialized. I think we were briefly over 100 for a few days, and then what? I mean, was that a signal of the resiliency of the energy markets, or what?
We entered this conflict from a place of oversupply. You know, on January 1st, we were talking about $55, $50 oil. And so I think that played more of an impact, or played more of a role than we thought it was going to. And so you just ended up with a market that was more resilient than anyone gave it credit for. But there is this broader conversation of the market is resilient. And this was a discussion that even happened after Ukraine. The oil market can take what you throw at it.
All right. Will Kobzanski, who covers energy for us here at Bloomberg, a closer look at the drop that we've seen in oil futures over the past 4 days, including what was about a 5 to 6% drop here on this Tuesday afternoon.
Yeah, and it's going to be interesting to see how this sort of trickles into U.S. gasoline. You think about prices still well above $4 a barrel in most parts of the country, particularly in New Jersey, where I live, and it's going to be interesting to see when we get to that 3 handle.
But prices in New Jersey are supposed to be cheaper than elsewhere, right? Because you have lower taxes?
I only drive in New Jersey, so I can't really
Well, I know my wife
you.
actually crosses the bridge to go fill up in New Jersey just to save
I never see
however
her.
many pennies. You should wave at her next time. So.
I'm gonna keep an eye out.
She's a very slow driver. All right, coming up, we're going to talk the World Cup, Katie. It's going on, and apparently it's fueling the economies of host cities across the U.S. We're going to catch up with Larry Freedman. He's the co-chair of the Los Angeles FIFA World Cup Host Committee. He's also, of course, with LAFC. He's going to be joining us in just a second, right here on The Close, right here on Bloomberg. The World Cup underway in North America with the city of Los Angeles a major focus on the global stage. Inglewood, to be specific, hosting 12 matches this year, including a thrilling match last night between Iran and New Zealand. Joining us right now is Larry Freedman, co-president of the Los Angeles Football Club and co-chair of the LA 2026 FIFA World Cup Host Committee. Larry, thanks for having us here. And before we start with 2026, I do want to go back to the 1990s and the last big World Cup that we had here, which, of course, put a lot of focus on international soccer in the United States, but more importantly on LA itself. And then, of course, the Women's World Cup a few years after that here. Kind of draw that line from where we were back in the 90s to what the demand is and, more importantly, the interest is today in 2026.
The difference between those World Cups that were in the 1990s and what's happening now in Los Angeles and other host cities, and will happen again in 2031 when the Women's World Cup comes back to the U.S., is that at that time there were not first division professional leagues for either the men or the women. The MLS, the league that LAFC and the LA Galaxy play in, was born out of that 94 World Cup. And now you have 30 teams competing, 3 in Canada, 27 in the US and MLS. And you have cities like Nashville, Tennessee and Austin, Texas, who built beautiful soccer-specific stadiums. They fill them for every match. They have raucous supporters. And you now have the ability in this World Cup, because of that presence, those 30 teams, many of those teams have players that are playing on their national teams. A good number of the clubs have players that are on teams that qualified for this World Cup. You've got Messi in Miami. You've got Sung Heung-min with us at LAFC. You've got a good number of Canadian national team players like goalkeeper Max Crepeau playing in Orlando. And so I think the biggest difference now is the ability for the ardent football fan as well as the casual sports fan to connect those dots between what's happening in this incredible global tournament and what happens here week after week in MLS.
Well, that's what I'm curious about, what the feed through is. And I mean, we go back, I mean, everyone remembers that Rose Bowl match, Brandi Chastain, and at the end there, taking off her jersey and waving it around. And it brought a lot more interest to the sport. And I am curious as to how you make sure you translate that. I mean, obviously, there are diehard fans that are watching this that will always be around. But those types of moments bring a lot of casual folks into this sport that wouldn't have existed before.
Yeah, so I think the way that we as a host committee have approached this, the way that LAFC as a club has approached it, I think the way that clubs across MLS are approaching it is through soccer celebrations and fan zones throughout the regions surrounding the various host cities, so that as many people as possible have the opportunity to participate in the tournament, regardless of whether or not they wanted to buy a ticket and go to a match at SoFi Stadium or Arrowhead Stadium or Hard Rock Stadium. You have the ability to get out in your community and participate and experience what the beautiful game does like no other sport, which is bring people together.
Let's talk about some of the logistical concerns as well. Of course, we have plenty of games going on at MetLife here, which is just a couple of miles outside Manhattan. Traffic is certainly a hot topic, particularly for me. I live in New Jersey, but I wonder, how you're handling that in LA, and additionally, security concerns as well. You think about the Iranian team playing in Los Angeles. It looks like, of course, the first game against New Zealand went smoothly there, but talk us through, some of the logistical and, again, security concerns.
Sure. From a logistical perspective, we here in the City of Angels, not unlike you folks out in New York and New Jersey, traffic is just part of day-to-day life. It's no different in Chicago, Dallas, other big cities, and you just have to plan accordingly. You can't expect to show up 15 minutes before kickoff at SoFi Stadium or MetLife Stadium and think that you're going to get into the match. But I think, there's a lot of messaging in and around Los Angeles on match days to try and avoid the freeways and use public transportation where it's available. And from a security perspective, obviously, we took this very seriously from the minute we were awarded host city status. We were planning and we were getting organized. We were communicating with law enforcement at all levels to make sure that we put on a safe event. And obviously, too, last night there was some heightened concern because Iran was playing its first match in the tournament here in LA. And by all accounts, last night was a smashing success. We had over 70,000 people in the building, which is about the same number of people who were there for the last Super Bowl that was hosted in that very same building. And we had a great match. We had loud representation from all fan bases. And from an event security perspective, there were no more, no less incidents than a normal event at a venue of that size with that size of a crowd. It was great.
Yeah, absolutely. Good to hear there. And just on the traffic, I will know that France is playing Senegal over at MetLife as we speak, and it was interesting to just see how empty the path was this morning. I think a lot of people took the opportunity to work from home. But Larry, I mean, to go back to what you and Romain were talking about, you think about coming out of the 1994 World Cup, how that was really a moment for soccer in the United States. You know, as co-president of the Los Angeles Football Club, now that we are hosting the World Cup once again, how do you capitalize on this moment and keep that momentum going once we're through the games themselves?
I think the key thing that we have to do is tell the story and connect the dots. Again, in '94, you couldn't say with players like Alexi Lalas, well, after the World Cup is over, you know, there's a team in Chicago or there's a team in Dallas or Houston where you can go see Alexi play for his club team. Now you have that opportunity when you're watching the captain of the defending reigning champion Argentina and you're watching Leo Messi work his magic on the World Cup stage. You can say, this is great. When this tournament is over, I can go see him play in New England, in New York, in Chicago, in Houston, in Dallas. Same thing with the captain of South Korea, Sun Heung-min, who plays for LAFC. You can come see him at our stadium. You can go see LAFC on the road. And I think it's a great story to tell about all of these national team level players who compete in our league, including some like Denis Bouanga, our leading scorer who plays for Gabon, who unfortunately was eliminated by Ivory Coast, who played a great game the other day. The ability to tell the story that these same players are playing in our league, in your town, is a great narrative, and it's a narrative that could not be used in the 1994 World Cup.
All right, Larry, really great to get some time with you. Appreciate your perspective. That is Larry Freedman. He is co-chair of the LA 2026 FIFA World Cup Host Committee. And I really do think even a lot of people at Bloomberg chose to work from home today on match day because I didn't have to fight anyone for the good yogurt this morning.
But is that frozen yogurt?
No, unfortunately, no. It's just, the non-fat Greek yogurt.
Oh, that's kind of boring. At least it didn't cost you $30.
I do have to fight Tim Stanovic, though. He's big on yogurt. But in any case, let's take a look at how these markets closed out on the day. The S&P 500 finishing lower by about 0.6%, breaking that win streak that we saw. A lot of the weakness coming through in some of the high flyers in the chip sector. The Philadelphia Semiconductor Index down 5.7% as Brent continues to fall below $80 a barrel, and gold, a little bit of a rise today, higher by about 0.5%. This is the close. House Democrats are targeting 5 key priorities in the lead up to this year's midterm elections, including lowering the cost of living and blocking President Trump's immigration policy, according to a report out of Bloomberg Government. Joining us live to discuss the key issues at stake in the heat of the primaries is Neera Tanden. She is CEO of the Center for American Progress and former domestic policy advisor and senior advisor to President Joe Biden. Neera, would love your perspective here on what you think the key messaging coming out of the Democratic Party should be as we roll closer and closer to the heart of those midterms. Certainly, it's the cost of living is something we talk about a lot on Bloomberg television. And I wonder, how you would expect the Democratic Party to sort of attack that issue.
Yeah, I think that the top issues for voters are cost of living, cost of living, cost of living. And in that bucket or in that group is the high cost of gas, utilities, food, healthcare, childcare, and just it's overall people find it very difficult to make ends meet. And in housing, for example, an area which has acute challenges, acute cost challenges, particularly in cities. I think Democrats are thinking through ways to build more supply, to make it easier to build, permitting reform, other issues like that, but also ways to ensure that renters, homeowners get actual savings. We put forward ideas at the Center for American Progress. A lot of Democrats are taking up those ideas. Those ideas would give rental relief, not rent control, but rental relief, right, and access to home ownership.
Well, let's talk through some of those proposals, because certainly you think about the cost of, everyday purchases that one needs to make. You think about energy bills. Some of that's being driven by supply shocks, mortgage rates being at these high levels that they have been. I mean, certainly that feels like it's becoming a structural issue. So what are you proposing over this at the Center for American Progress?
Well, we should be honest that there's two policies, policies by the Trump administration that have driven up costs. One is the tariffs. The tariffs are pretty haphazard, but the tariffs have driven up costs for goods across the country. The other is the Iran war. Obviously, that's having an impact on gas prices, but as you know, gas prices kind of have an cascading impact across the economy. So those are two policies that I think Democrats would reverse. Obviously, the president is engaged in a process of ending this war, but the tariffs are another area in which families are experiencing an increased cost because of the decision by the president to impose those tariffs. So there's, first and foremost, things you wouldn't do. Tariff policy is one that we wouldn't do. I think Democrats would say they voted against the tariffs multiple times, and if they have the majority, it could really have an impact there. And then, of course, there are specific items like utility costs. And there, I think we need to do increased supply of energy, but also ensure that the impact on the grid, data centers are not being borne by everyday consumers.
I am curious, though, Neera. I mean, it's one thing to sort of lay out policy proposals. It's another thing to actually have the actual political messaging to sort of make sure that you actually get elected so you can implement those policy proposals, not something the Democrats have had a great track record in recent election cycles here. What have you heard with regards to how are they trying to create a more unified message, or is this really going to be a state by state, district by district type of campaign?
Look, I think you are already seeing Democrats having success on cost of living issues. Abigail Spanberger ran for governor in Virginia. Mikey Sherrill ran for governor in New Jersey. Mikey Sherrill talked about utility rates. She proposed freezing utility rates. Governor Spanberger talked about lowering housing costs, lowering energy costs. They both won pretty historic victories, double-digit victories, and Abigail Spanberger won the largest victory of any governor in modern history in Virginia. And so I think actually candidates are taking cues from what has worked in these elections they'll have their own ideas about how to lower housing costs, utility costs, food costs, healthcare costs. The opportunity here is that there are a lot of costs that have been rising over the last year or so and over several years. And I think people are looking for ways, leaders who have ideas to lower costs, not 10 years from now, not 5 years from now, but in the next year or two. The thing that's really surprising is how low consumer confidence is. You know this better than I do. We have historic lows on consumer confidence at a time where we have relatively low unemployment. That tells me voters are really struggling to make ends meet.
Absolutely. You see it reflected in the data, both hard data and anecdotal. Neera Tanden, CEO of the Center for American Progress and a former advisor to President Joe Biden. Now, we do want to stay in the political realm because the former President Barack Obama is opening his presidential center. The official opening coming on the 18th, with the public allowed to start accessing it on June 19th. We had a chance to catch up with Valerie, Jarrett, the longtime advisor to the president, who is now the CEO of the Obama Foundation. We asked her about the legacy of the 44th president of the United States and what this means for the city of Chicago.
We are very excited to open the Obama Presidential Center this week. I think that it is very timely on the 250th anniversary of the birth of our country. And in fact, our museum begins on the ground floor, not with the election of President Obama, but rather with the Declaration of Independence. And it tells the story of all the zigzags of our country, from the suffrage movement to civil rights, going back to slavery, then Reconstruction, the immigration rights movement, the LGBTQ rights movement, all of the different movements in our country, and zigs and zags and progress that we took that led to the president's election, and then the story of his presidency. And so the timing is just right.
It's been 13 years since we saw the last presidential library dedication. What a 13 years that has been. And now, of course, this opening is happening at a time when you think about some of the policies that President Obama really made his landmark and are really known for have been sort of dismantled over the past several years. And I wonder, what this moment feels like right now.
Our opportunity now is to instill in people a sense of hope that ordinary people can still do extraordinary things. And so the status quo is not going to be permanent. It never has been in our nation's history. And so the question is, are people ready to take up the baton and run the next mile? And that's how our country has always made progress. And I talk about the zigs and zags because that's been the history of this country. And so in this moment, we want people to still feel hopeful. We want them to feel that they have the capacity to make the world a better place, that we have more in common than we have differences, that we welcome people to the campus who have different ideas than we do, and let's have a debate without being disagreeable. Let's all work to actually strengthen our democracy. That's our message, and that's what we think people will feel, this sense of hopefulness when they leave the campus and come back time and time again.
Well, Valerie, you mentioned different ideas, and I do want to bring up President Donald Trump directly here, because my understanding is that this opening, it'll be the first time that a sitting president won't be at the center stage in a modern presidential library and museum opening. And you have said publicly that President Trump has not been invited to the opening ceremony that is this week, but that you would welcome him for a tour. So I am curious, is that an invitation that you have extended at this point, and have you gotten a response?
It's an open invitation, and we have not yet heard a response. And look, keep in mind, this is a celebration for all of the folks who enabled President Obama to serve our country for all 8 years successfully. We have the construction workers who worked on this campus, and we have an alumni who worked in the campaign and in the administration. We have our generous supporters coming. We have state and local and federal elected officials who've all been supportive of President Obama. So this is a celebration for them. But when we open to the public, well, then, of course, everyone is welcome.
I grew up in Hyde Park, right on 49th, and I'm very familiar with what Jackson Park is and what it used to be before the center came into place. I used to, every day leave St. Thomas and we run over to the point and hang out there. This is also altered physically the Frederick Law Olmsted map of what Jackson Park was. And I know there was some controversy in that. And I am curious as to what you think the overall net benefit will be of this larger footprint, of the reimagining of Jackson Park overall. Is that going to benefit the community, the surrounding community, or is that solely for the benefit of the Obama Foundation?
Great question. And I grew up here, too. I grew up on 49th Street and rode my bike through Jackson Park and hung out over at the point. So you and I had a very similar experience, and this is a net benefit. We got rid of Cornell Drive, which you will remember was that 6-lane highway that separated Jackson Park from the Museum of Science and Industry. And so with all of our buildings, we have added 3.7 acres of open space. So there's far more open space on the site now than there was before. And we have world-class playgrounds and the athletic center and the library and walking trails and a vegetable garden and picnic tables and barbecue pits. And so, yes, if you ask the surrounding community, as we did a few weeks ago at our public hearing, is the community thrilled by what we have produced? Absolutely.
That is Valerie, Jarrett, the CEO of the Obama Foundation, talking about the opening of the Obama Presidential Center in Chicago, which opens officially later this week. All right, we're going to set you up for what to watch in financial markets when we come back after the break. Stick with us. This is Bloomberg. All right, it was a somewhat mixed day in financial markets here on this Tuesday afternoon. That could change on Wednesday with a lot going on. And we start, I guess, globally with a closer look at the oil market.
Yeah, coming in at 4 a.m., we're going to get the IEA monthly oil report. So something to wake up to here. And certainly the stakes have been raised when you think about where the oil market stands right now in that big rally, or rather plunge that we've seen.
Absolutely. They're going to have to address that. And then at 8:30 a.m. Eastern time, we're going to get that U.S. retail sales report, which has been surprisingly strong in the months past. This one is also expected to be relatively strong with just roughly, about 0.6% month over month if you exclude autos.
Yeah, absolutely. The U.S. consumer continues to impress. We're also going to get at 10 a.m. pending home sales and business inventories. Pending home sales, particularly interesting when you think about that weak housing starts number that we got this morning.
But of course, all eyes are going to be at 2 p.m. Eastern time, Washington time to be specifically, when the Federal Reserve, the FOMC, puts out that Fed rate decision at 2 p.m. and then that guy who was just up there, Kevin Warsh, takes the podium at 2:30.
It's going to be interesting to hear from the man himself. Of course, a lot of speculation about what he'll have to say about where he's leaning when it comes to the rate trajectory, but also when it comes to communication coming from the central bank itself.
Yeah, one of those meetings that will be less about the rate decision itself and about everything else. Our full coverage starts at 1:30 p.m. tomorrow Eastern time, right here on Bloomberg.